Good afternoon, everyone. This is Henry. As we get into the free video tonight, I wanted to spend a little bit of time here on the put-call ratio versus the SPY and some of the content that I've been working on for the YouTube series here throughout the week. If you've been following my videos as they come out, well then maybe you caught last night's review and the idea that said from this swing low to this swing high, we had an important 618 retracement, and for the most part, I would really prefer to short a move back into the 21 EMA based off the idea that sentiment is a little bit too bearish. Well, then you have a day like you have today, which is another significant move down lower. And you look at this and think, is that still the idea? Like, is there still merit to trying to pursue things in this way? And what I would like to show you for this are some of the most extreme readings we've seen this year. So what I'm looking to is just this put-call ratio and the extremes that it has made. Namely, this one right here, as we're going to look at this, I believe on the 17th, but you can see the 16th. So on this day, the put-call ratio has a high of 1.35, which essentially means that, those buying puts were outpacing those buying calls to that degree. And, the general retail public often focused on just buying calls, right? Then, as you get a little further into it, buying puts, etc., placing hedges. Also, there are many ways that you can get short. But the idea here is that your general retail trader, when they wake up and see a day like you had today, is going to go out there and buy a put on the spiders. As they start accumulating all those put options, it drives up this ratio. And as we take this from June 16th and then move it down here into the SPY, do you see how that reading was one day off of making the low that led us from 360 all the way back into 430? So these extremes in sentiment, I do believe are significant. And what I believe, or at least what I am considering the potential of, as with all of this, you have to take it from what I give you here on Friday's close, see if it makes sense with the futures open on Sunday, carry it into Monday. If I'm totally wrong, well then of course I'm not going to be trying to force this idea. But what I want to consider the potential of is that something like what happened here is going or could occur here, right? Where if you get a gap above, because think about how we ended the day, right? Essentially near the highs of the session. So as all of those participants got short, kind of got ground higher into the end of the day, if that type of sentiment can lead to a gap higher on Monday, you could see some abandonment of this candle down here around 384, and I believe that could bring the reversion to the mean. Now, again, I'm not telling you that this is a bottom that's going to last for, 3 months. I'm just telling you it's a spot where participants may be a little bit overly bearish, and the reversion to the mean would not surprise me. So I hope that helps. I hope it comes across in the right way. I think if you bookmark this and come back into it 7 to 10 days from now, it will be meaningful, and we'll continue to keep tabs on it as it unfolds. So y'all have a great weekend, and I will see you in the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful, and if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.